you need to stop everything you are doing right now. We've got this deep dive that honestly exposes a financial strategy promising these astronomical yields. Yeah, we're talking up to 202%.
202%.
But it's silently like destroying investor portfolios. You won't believe the collective losses we've uncovered, even while the underlying stocks were actually soaring.
Yeah, it's why
we're diving into this hidden trap that, frankly, looks like 90% of investors are just falling right into.
And look, this isn't just, minor underperformance, not at all. This is systematic capital erosion, kind of masked by these massive headline-grabbing dividend numbers.
Totally.
Get ready, because we're going to show you the data, how millions are being lost. We've got, 15 crucial insights from our analysis. We'll cover them one by one.
Yep, page by page. You're with ChannelVest, your expert in ETF strategies. And hey, do us a favor, like this video right now.
Yeah.
It really helps us reach more investors who definitely need to hear this truth.
Please do. Okay, first things first.
Before we jump into the crazy numbers, we absolutely have to cover the critical disclaimer.
Yes, absolutely essential. We need to be crystal clear here. ChannelVest, we provide research, educational content only. Okay, we are not registered investment advisors. We're not brokers, not fiduciaries.
Right.
Use this info, for your own research, dig deeper, but please talk to a qualified financial professional before you make any investment decisions.
Definitely.
Our mission is just to lay out the data, expose what we found purely for your education.
Okay, disclaimer done. Now let's get into the shocking truth about YieldMax. And this is the paradox that just jumped out at us.
It's pretty stark.
YieldMax has grown huge, right? Like $16.29 billion in total assets. That makes them the 32nd largest U.S. ETF provider. And they grab headlines with these maximum yields, MSTY, at 202%.
Mm-hmm.
It's insane. How can the yield they say they have be so high, but investors are actually losing money?
Well, that's the million-dollar question, isn't it? Or maybe the negative $35 million question for some. The tragedy is really in the math, our analysis. It shows the average YieldMax investor has lost 11% annually since late 2022.
Wow. Annually.
And look specifically at CoinOI, right? The Coinbase ETF.
Right.
Investors in that fund collectively lost $35.5 million in capital. And get this, that's despite Coinbase stock itself having, phenomenal returns during that time.
So the stock did great, but the fund lost money.
Exactly. The structure itself is bleeding capital even when the underlying asset is winning. It doesn't make sense on the surface.
Okay, so if they're not just holding the stock like a normal fund, how on earth are they generating these massive premiums? We got to understand the synthetic covered call illusion.
Right. This is key. A traditional covered call, it's pretty straightforward. You own the actual stock, say 100 shares, and you sell a call option against it. Simple enough. YieldMax. They use a synthetic strategy. It's more complex. They buy call options, and at the same time, they sell put options. Now, together, that mimics owning the stock synthetically. It's called a synthetic long position.
Okay, synthetic long.
Then on top of that synthetic position, they sell call options, just like in a traditional strategy, but on the synthetic holding.
Whoa, okay. That sounds incredibly convoluted. What's the bottom line for someone just trying to understand this?
The bottom line, they're basically creating leverage to juice up the premiums they collect. They're betting for the stock to go up with that synthetic long part.
Right.
But they're simultaneously betting against big upward moves by selling the calls, which caps almost all the potential capital gains.
Ah, okay.
It's like entering a race, but you've tied your shoelaces together. You collect some premium maybe, but you're pretty much guaranteed not to win the actual stock appreciation race. Yeah. You cap your upside dramatically.
And the fallout from that complex, maybe confusing structure is just laid bare when we look at the NAV erosion nightmare. This seems like the core, the absolute engine of the portfolio destruction we're seeing.
This is where the rubber meets the road, and it's not pretty. Look at the examples. TSLY, the Tesla one, its net asset value, that's the actual value of the shares you hold, it's down a devastating 64% since it launched back in November 2022.
64%.
64% down. Meanwhile, Tesla stock itself, over that exact same period, it gained 120%.
That is nuts.
It's completely upside down. TSLY even had to do a 2-for-1 reverse split just to prop up the share price because it fell so low.
Wow.
And it's not just TSLY. CCOIN, the Coinbase one we mentioned, its NAV cratered 34% while the underlying coin stock surged 213%. NVDY, the NVIDIA one, down 38.66% over 1 year while NVIDIA was, dominating everything.
So the trap is clear.
Absolutely. The covered calls they sell cap your upside. Maybe you get 0 to 15% potential gain in a month from the options, but you absorb 100% every single bit of the downside when the underlying stock tanks. There's no protection there.
Wait a second. If the actual value, the NAV, is collapsing like that, where is that 200% yield even coming from? That leads us straight into the, frankly, devastating reality of return of capital. Your money returned to you.
Right. This is the sleight of hand, you could call it. A huge chunk of those massive dividends or distributions, people say. It's not profit. It's not earnings from the strategy.
What is it then?
It's the fund manager literally just returning your own initial investment principal back to you, your own money.
No way.
Yes way. Look at the data we pulled. ULTY shows a staggering 95.96% of its distribution was return of capital, 96%. MSTY is sitting at 64.79% OC.
So most of that huge yield is just my own money coming back to me.
Pretty much. That capital just gets moved from the NAV column, which is shrinking, over to the distribution column, which looks big. And all the while, the fund is trimming off its fees, which are not small, 0.99% to 1.44% right off the top before they give you your own money back.
They're charging you a fee to return your own capital.
That's exactly what's happening. We're calling it capital cannibalism. It's designed purely to keep those headline yield numbers looking incredibly high, but it's completely unsustainable. It eats away at your investment.
The proof, I guess, is right there when we look at the actual one-year performance, the brutal reality.
Yeah, forget the headline yield for a second and look at total return, that's share price change plus distributions. Despite those massive advertised yields, the strategy largely failed, even in what was generally a pretty bullish market overall.
What do the numbers show?
Our data shows 6 out of the top 7 YieldMax funds actually posted negative one-year total returns. SMCY was down a brutal 74.34%. TSLY down 45.62%, NVVY down 38.66%. These are huge losses.
Was there anything positive?
Well, there was one exception, PLTY, the Palantir one. It managed a positive return, but only because Palantir's stock surge was so incredibly violent and bullish that it just temporarily overwhelmed the strategy's built-in limitations.
So it took a massive outlier move just to break even or make a little.
Basically, yeah. It kind of proves the point, actually. The structure itself seems fundamentally flawed for delivering consistent positive total returns. The Palantir case was the exception that proves the rule.
Okay, so if the returns are generally this poor, why wouldn't investors just choose something, more established, more proven? Let's put this into perspective with YieldMax versus proven alternatives.
That's a great question. We compared them directly to some well-known traditional covered call ETFs like JPI and JEPQ from JP Morgan.
Okay, how do they stack up?
Well, over similar periods, those funds, JPI and JPQ, they actually delivered positive total returns for investors. And importantly, they charge a much more reasonable expense ratio, around 0.35%.
Okay, 0.35%. And YieldMax.
YieldMax funds, on the other hand, are posting these severe negative total returns we just talked about, yet their expense ratios are roughly 3 times higher. They're hovering around 0.99% to 1.01% for the single stock ones.
3 times the cause for negative returns.
Exactly. They're hemorrhaging investor capital while extracting, basically maximum costs. It's a really tough combination for investors.
Yeah, no kidding. Okay, moving beyond just the return aspect, let's talk about the ride itself. Extreme volatility, the hidden risk. Because for people looking for income, this kind of volatility must be absolutely terrifying.
Terrifying is a good word. This is absolutely not passive income generation. It's pure speculation, plain and simple. Look at MSTY, the one with the 202% headline yield. It has a daily volatility of 71.28%.
Daily volatility, 71%.
Yes. That's higher than most individual meme stocks. It just shows how incredibly unstable the underlying options mechanism is. This isn't stable income. It's riding a bucking bronco.
And what about drawdowns, like the biggest dips?
We documented maximum drawdowns. That's the peak to trough decline of over 40% for both ULTY and YMAX. And get this, LFGY suffered a brutal 34.73% drawdown in a single month, April 2025 alone.
A third of your money gone in a month.
Potentially, yeah. You're taking on just massive, massive risk. And as we've seen, often for negative potential return. It's a terrible risk-reward proposition for income seekers.
And adding insult to injury, they're charging a fortune for this chaos, which brings us right to the fee structure scandal.
Yeah, the fee structure really seems designed primarily for revenue generation for the fund managers, almost completely disconnected from whether the investors actually make money.
What are the specifics?
The single stock funds, as we said, charge between 0.99% and 1.44%. That's already high. But then you have YMAX, which is the fund of funds that holds other YieldMax ETFs.
So fees on top of fees.
Exactly. It's a fee multiplier. YMAX itself charges 1.28%, plus you're indirectly paying the fees of all the underlying YieldMax ETFs it holds. So the total annual cost can rocket up to roughly 2.43%.
2.43%. Just think about the long-term impact of that. Like over 10 years, if you put in $10,000, YMAX would cost you around $380 in fees. Compare that to JEPI at 0.35%, which would be about $378.
Right. That's over $1,000 more, just vanished into fees, regardless of performance.
Wow.
And Academic research consistently shows this stuff. Even a 1% difference in fees compounded over, say, 30 years can reduce your final wealth by 25% to 30%. This kind of fee structure, especially when paired with the capital disruption we're seeing, it's just financially devastating long term.
It really sounds like it.
Yeah.
Okay, quick pause here. If this deep dive is helping you understand the real costs behind these crazy high yields, do us a favor. Hit subscribe right now, ring that notification bell, and let us know in the comments, what do you think of this fee model? We want to hear from you.
Yeah, let us know. It's important stuff.
Okay, so it's not just our analysis pointing this out, right? Let's look at what Wall Street analysts are saying. Are the pros seeing the same thing?
They absolutely are. The professional analysts are definitely confirming our findings. We saw Jeffrey Peacock from Morningstar, a big name in fund analysis, note that investors are going into these expecting, large distributions of actual income and capital gains.
Right, that's the problem.
Which the fund structure just hasn't delivered, plain and simple. And then you look at headlines on platforms like Seeking Alpha, which a lot of serious investors follow, they've been incredibly blunt.
Like what?
Headlines like, capital erosion likely to worsen in H2 2025, that was for ULTY, or for YMAX. A 70% yield that's mostly illusion. And for MSTY, they just flat out called it all smoke and mirrors.
Wow, all smoke and mirrors.
Yeah. These aren't fringe opinions. These professional statements really validate the systemic failure that our data has uncovered. It's not just a bad run, it's the structure itself.
Okay, to put maybe the final statistical nail in the coffin here, we need to look at the risk versus the reward. Let's talk about risk-adjusted returns, the statistical horror.
Right. For this, we use standard metrics like the Wpay ratio. Basically, it measures how much return you got for each unit of risk you took. Higher is better means you were compensated well for the risk.
Makes sense.
Now, those proven alternatives we mentioned, JEPQ and JEPI, they have solid Sharpe ratios close to 1.0, which is quite good.
Okay.
And YieldMax.
The YieldMax funds like TSLY, much weaker, down around 0.35. But here's the kicker. YMAX, the fund of funds, posts a negative Sortino ratio of not a 0.02.
Negative. What does a negative Sortino mean?
It's really bad. The Sortino ratio specifically looks at return relative to downside risk, the risk of losing money. A negative Sortino means that for all the extreme downside risk you took on by holding YMAX, you received negative excess returns compared to a risk-free investment like Treasury bills.
So you actually got punished for taking the risk?
Statistically, yes. You literally paid through fees and losses to lose money on a risk-adjusted basis. You would have been genuinely better off just holding simple, boring Treasury bills.
That's damning. And all this systematic destruction, the return of capital, the fees, it's led to a pretty colorful term among retail investors. The PonziMax controversy.
Yeah, that term is definitely floating around online, places like Reddit. Now, it's really important we clarify legally, technically, these are not Ponzi schemes. A Ponzi scheme has a very specific legal definition involving fraud and paying old investors directly with new investors' money with no real underlying investment.
Right, important distinction.
But the critics raise 4 extremely strong arguments that highlight why people use that term, pointing to its, let's say, predatory nature.
What are those arguments?
Okay, first, the massive return of capital, like we saw, 50% to 100% of the distributions can just be your own money back. Second, critics argue that the new money flowing in, attracted by those huge headline yields, is effectively needed to help fund those roll distributions to the earlier investors, creating a similar dynamic. Third, the NAV erosion, the actual value destruction, is cleverly hidden behind the big distribution numbers. Most people don't track NAV daily. And fourth, the management fees. The managers collect an estimated $190 million annually based on assets under management completely, regardless whether investors actually make a single cent of profit or, more likely, lose money.
So the managers get paid no matter what?
Pretty much. As one Redditor bluntly put it, talking about the dedicated followers, the people still buying these funds are in the cult.
It speaks to the disconnect between the marketing and the reality.
Wow. Okay, so after digging through all of this data, all 15 points, who on earth should actually buy this stuff? Let's start with a final verdict. Who should buy YieldMax? But maybe we should frame it as who should absolutely not buy YieldMax.
Yeah, let's start there because that's the vast majority of people. The never buy criteria are pretty clear based on everything we've seen.
Lay it out for us. Okay, if you are a conservative retiree, say 60 plus, absolutely not. If you're looking for stable, reliable buy and hold income, definitely not. If you're someone who can't or won't monitor your positions daily, steer clear.
What about tax implications?
Big one. If you are investing inside a tax-deferred account like an IRA or a 401k, never buy these. Why? Because return of capital offers zero tax benefit in those accounts. It's just destructive. Normally, RICT defers taxes in a taxable account, but here it's pointless.
Good point.
And fundamentally, if you simply cannot afford to potentially lose 40% to 50% of your investment, or maybe even more, these funds are fundamentally unsuitable. They are not stable income vehicles by any stretch of the imagination.
Okay, so that covers a huge chunk of the investing public. But you mentioned there might be a tiny, highly specialized sliver of the market who could maybe consider these. We need to be super clear about the very strict rules for that group.
Extremely strict rules. This is absolutely not for the average investor. These funds might be considered, and that's a big might, if
What?
If you are a highly sophisticated trader, someone with deep practical options trading experience, who understands synthetic positions, volatility, decay, the whole 9 yards.
Okay, expert level.
Expert level. And your time horizon must be very, very short. Think maybe 6 to 12 months max. You have to view it purely as a speculative trade, not an investment.
Not buy and hold.
Definitely not. And allocation. No more than maybe 5, absolute maximum 10% of your speculative portfolio allocated to these things. And critically, you must monitor positions daily, maybe even intraday, with strict stop losses in place to cut losses quickly.
So active trading, tight risk control.
Exactly. Think of it as a potential tool for trying to extract some premium from volatility in very specific market conditions for a very short time. It is absolutely not a long-term investment or an income strategy for most people. It's a high-risk trading instrument.
Okay, that really puts it in perspective. That covers the maybe consider group. And that actually wraps up our deep dive, hitting all 15 insights from this analysis. Final thoughts.
So what does this all really mean when you boil it down? I think the data makes it just undeniable, these incredibly high yields. They're effectively worthless, or worse than worthless, if they are simply achieved by returning your own principal back to you.
Right.
Compounded by charging you 3 times the typical industry cost for the privilege. The real question isn't if these funds are destructive, the data shows they are. The more interesting question is why they remain so popular despite this horrific track record we've just laid out.
That is the question.
Yeah.
And guess what? We think we've got the answer, and maybe even a potential solution. We actually teased it on the slide. Our next analysis is called the YieldMax Killer Portfolio. Better yields without the NAV erosion.
Ooh, sounds interesting.
It is. So if this deep dive today maybe saved your portfolio or just opened your eyes, please share your story in the comments below. We genuinely want to hear about your experience. And hit that like button one more time if you haven't already. Don't miss our next breakdown.
Definitely subscribe for that one.
Absolutely. That's it for this deep dive. Thanks for joining us.